all of us on this call collectively want to do better. Now, if it's just financially, great. If it's financially and philanthropically, fantastic. If it's family and in your home, even better, right? All these things, but this is stuff that most people don't know about. Like, this is like, how would you like to get tax-free retirement? How would you like to create tax-free retirement income? With your life insurance, and then also a little bit of savings, right? We sell a lot of HMS term, great product, right? Does a good job for what it's for, protecting the mortgage. But beyond the limits of $450,000 of protection, like, you can get an IULs with millions of dollars of protection, people that maybe have bigger needs, as well as leveraging the growth potential that you get to take advantage of with the option purchasing through the S&P. Bridget, guys, everyone, she is the director of SRS. She's going to go through IUL 101 and how to solve the two needs of your clients with an annuity, which is what you're going to be looking for when you're meeting with clients, either on the phone or in the home, or people out in society. I told a story recently. It was one of our agents was at a party, I think a birthday party for his daughter or something. And a guy goes up and he goes, "Hey, do you do life insurance?" And he's like, "Yeah, I do life insurance." He's like, "I'm about to buy an IUL. Do you do those?" He's like, "Yeah, I do IULs." He's like, "What were you looking to put into it?" It's like, I was looking, like, the guy had me quoted about $5,000 a month. And I'm like, he's like, "Oh yeah, I definitely do IULs." And he transitioned, but just found the guy online, went to our guy who's in our downline, and recently issue paid. And that's just part of what you now offer, guys, is these higher quality products, higher value products to protect money, help people plan for retirement, and protect their money long-term with guarantees. So I'm going to zip it, but Bridget, beyond excited, guys. The director of SRS is on with you, so enjoy. And thank you for being on with us today, Bridget.
Yeah, thank you, Grady. I love that story because, I tell agents, they're like, "Well, how do I let people know that's what I do?" I put it on your signature, on your business cards. You're not just a life insurance broker. I do retirement planning, IUL, tax-free retirement solutions, right? Like, list them all out so that it's out there in the open and people know what you have access to. Whether or not you know it yet, we'll help you know it, right? But don't be afraid to advertise yourself as the holistic broker that you're talking about. And then people will come alongside you and help you get to the speed you need to be to offer all that to your clients. So love it. All right. So like you said, we have 2 trainings today. The first one I'm going to go through is an IUL 101. So keeping things really basic and just defining that for people who don't know what that is. So I'm going to share my screen here and get going. And Grady, if you can just confirm you see that there.
Perfectly.
Perfect. All right. So like I said, IUL 101 today, and I really truly want this to be just that. It's not to overcomplicate it. It's not to confuse people. IULs are truly a fairly simple product, and they're already in your life insurance realm. So the underwriting and the qualifications, smoker status, medications, all this stuff is information you gather in your normal scope of business, and you can transfer those to an IUL. So let's dig in on what it is and what purpose do they actually serve for our clients. So I like to define the IUL as a product that can protect us now and later. Okay. And I'm speaking to one of the most popular reasons we use an IUL, okay, which is the protection for now and later. I would say that arguably the reason people purchase an IUL is for that tax-free retirement planning. I'm not saying an IUL can't be used for other reasons. 2 of the top ones, and this is a future training we're going to do, but more death benefit, right? More death benefit, that's whole life, as well as long-term care alternatives, right? But the third one is that tax-free retirement. And I would say that's really what we focus on and where the IUL becomes a super cool product. So protecting for now, meaning it offers us life insurance, and protecting for later, meaning it offers us a solution for tax-free retirement. So if we define an IUL, it's first and foremost a life insurance contract that provides your beneficiary a tax-free death benefit, right? We should all be very familiar with those terms because that's what life insurance is. And that's what we're out there offering and doing as our bread and butter of our business. The second feature, and this is the protect for later part, is an IUL is a life insurance contract still that can provide a cash accumulation value. And that, like I said, is the primary reason that I believe people, especially right now with less access to 401ks, volatile markets, are purchasing IULs, is for that cash accumulation. The monthly premium you pay for this policy, if structured correctly, goes to pay for both, right? So it's not, I need to put this money in this bucket and I have to divvy this up over here and I'm going to buy two products. It's one product that serves both needs, a life insurance contract and cash accumulation. So we're going to focus mostly on the cash accumulation side today because you know what life insurance is. You know what you're doing. You know how to purchase a death benefit, right? That's the self-explanatory, very familiar area for you. So I want to give you just a picture here of how that one premium goes to pay for both benefits. I'm using a hypothetical split of 50-50. Keep in mind, that is not the true for every case scenario. If I put in this much, 50% of my money goes to this and 50 goes to this. That varies by a lot of factors, right? Your rating, your classification, smoker, non-smoker, how old you are. But for easy math and illustration to get the point across to you guys, I'm going to use a 50-50 hypothetical split. So I'm quoted on a $250 a month premium for an IUL. How is that broken up? Half that premium, so 125 bucks, goes to my equaling of $100,000 death benefit, right? I'm purchasing a death benefit. The other half of that premium, $125, drops into the cash accumulation account. So Mr. Client pays one $250 premium a month, and the company, the IUL company, splits it. They put part toward the death benefit policy fees, the other part toward this cash accumulation. For easy understanding, let's call it a savings account, right? It drops into the savings account bucket. Now, keep in mind, due to MEC limits, right? We don't want this to become a modified endowment contract. We have to allocate a certain amount of premium to the death benefit. Why? Because this is first and foremost a life insurance contract, right? What I said first, the first purpose and how this is classified and issued by an insurance carrier is the fact that it's truly life insurance, okay? So remember, you're gonna have to spend a certain amount toward the death benefit. We can't just say, I wanna put in $500 a month and I want $25 a month of that to go toward death benefit and the rest in cash. That's a little too good to be true. Sounds super cool, could be cool. They don't let us do that, right? There's regulations out there that limit that. So keep in mind, a portion is always going to have to go toward death benefit. And the good news is those illustration softwares, our team kind of solves that for you. So you don't even need to know what that fine number is or what, that middle of the road is. We have programs out there that will calculate that for you based on the budget of the client, okay, and their goals. So because like I said, you already should understand life insurance, right? I don't need to explain to you how you bought a death benefit. So I want to focus on the cash accumulation side. How is that working? How is this insurance company offering me this savings account, right? Essentially, that can build up cash for my retirement. So IULs, just like fixed index annuities, use indexing in the market to build up cash value. Usually this S&P 500, right? That's a pretty common market and index people are familiar with. IULs mostly use that. It's where the money is indexed through options in the market, right? Versus directly invested in the market. So you're not buying stocks and mutual funds that are volatile. The insurance company is purchasing options on your behalf. This is the same for FIAs. And I point that out because you're not really having to learn two different concepts. There's so much crossover with IULs and fixed index annuities that if you can, figure out indexing and understand indexing, you can now accurately represent both products, right? Which is pretty cool. So again, indexing in the market versus directly invested. The amount of premium that you're putting in every month toward the cash value. So remember that split of $250 a month, that $125 that's allocated toward my cash value goes directly toward that. It drops right into that bucket and is immediately indexed on your behalf, right? So what are the features of indexing for IULs? What kind of factors does it include? It's a point-to-point crediting method. Again, this is the same thing for annuities, meaning it tracks with an index, whatever the index number is on day 1, and then day 365, the difference is your return, right? So if it's a 1,000-point index and it finishes at 1,100 point on day 365, that's a 10% gain, right? So point to point. People get confused a lot of times on that because they think, oh, I need to watch and I need to track up and down with the market. Indexing doesn't work like that. The expiration date of your option is that 1 year. So all you need to pay attention to is what you started at and what the last day of the year is for your contract. So that's called point-to-point crediting, okay? It will always have a floor. So an IUL is going to have a floor, same as annuities, you guys. And I'm pointing that out because, again, these concepts merge together so nicely. So the floor is always going to be at least zero. Zero meaning zero. You can't go negative. If we had no floor, that would mean you could lose money, right? Well, in an IUL, just like our fixed index annuities, the floor is always at least zero. The cool part about IULs is we have some carriers out there who actually offer a floor of up to 2%. So now your floor is not zero. You get a minimum of 2%, even if the market did nothing and the index was negative at the end of the year, you could get a floor of 2%. Varies by product, right? So keep that in mind. The index on an IUL is almost always going to have a cap, right? Our largest cap right now for the products we have access to is 12%. That's a pretty good cap if you ask me, right? So IULs have a cap. We deal with a lot of indexes on the annuity side that do not have caps. So that's one small difference. But because this is life insurance first, it's a little more regulated than the annuity side. So we have a cap. Highest one we have right now is 12%. Guarantees zero loss. That's ties in that floor that I'm talking about. So as long as you have a declared product with a floor of zero, there's no loss. And then just like the annuity world, it locks in the gains. And why is that important? Because if you earn 10% this year and next year it's negative 20, you locked in that 10%. No one's taken back that money to accommodate the 20% loss the market now saw, right? So locked in gains and the power of that compounding is massive. And that's what makes these IULs and FIAs such a popular option for clients today. So let's look at what that looks like. So explained the cash value, how it works, what features are involved, but what's that look like for your money? Okay, so assuming our same example of $250 a month, half of that's paying for my death benefit, half of it I'm dropping into that savings account. So it's $1,500 annual investment, right? So if I take $125 times 12, I get $1,500. So my first jar there is after 1 year, I've put in $1,500, right? Well, that index option expires and we see a positive 7%, right? Let's say in this example, our cap, we're using the product where the cap is 12. So we can earn up to that. So we have a 7% return on that index. That immediately also adds to my savings account. So they take that 7% of the option, they cash it out, and they put it in that bucket. So now my total is $1,605. Are you guys tracking? So year two, I start out, I locked in that gain, right? So I locked in that return and I now keep paying my premium. And at the end of year two, I put in another $1,500, right? So now my total investment with my previous return is that $3,105. And let's say at the end of that year, the index return was 10%. The annuity company credits that to me. I drop it in my savings account and I keep making my premiums, right? Third roll forward, just so you guys can see the power of this compounding. I've now put in another $1,500 of my own money through premiums, right? This year, the market returned the 12%, or maybe it returned 14, but my cap was 12 and I got all 12, right? So I add that, drop it into that savings account. And now at the end of that year three, my cash value is already at $5,500, right? That compounding, the locked in gains, and none of this was ever subject to any risk of loss, right? So that's the power of indexing. This is the same on the annuity side. It's just in this, you're making monthly premiums. On the annuity side, you're putting in a lump sum and it has the same effect, right? So you can see the power of that. That's how indexing works. Let's say in there was a year of zero, it just stays flat, right? Let's say that 12% was zero and I didn't actually have a return that year. Good news is I still start with that previous year's $3,400, right? And I continue to put in my premium year after year until retirement. The goal of these, you guys, for retirement is to stop paying, right? So we want a good enough runway on an IUL to contribute to this cash value account. And like Grady was saying, a $5,000 a month premium, that's not out of the question. You're building it on budget, right? So this one, I'm using a very low conservative, just average client who can put in $250 a month, right? Well, the idea is they want to stop paying in retirement. Remember, this is a tax-free retirement supplement. So just like my 401k, it would defeat the purpose if I retired, but kept contributing to my 401k, right? And wanted to try to take money from it. The idea is to contribute, then stop and live off of it. Okay. So this compounding is that cash value part of the IUL. Remember, it's also still a death benefit. So that $100,000, and a lot of times on IULs, you'll see that go up over time to stay in balance, and it offers both benefits. So what are the ways we access the cash value on an IUL? So how does this actually play out, right? What's the use of that? Again, the death benefit side's simple, you guys, right? I pass away, I had a policy, I have a death benefit, pays to my family, but I don't pass away, I'm retired. How do I access this cash value? There's multiple ways to do so. The first is just a typical withdrawal, right? I have, let's say, 50,000 built up in this cash value account. I have an emergency, car breaks down, I need to access some cash. I can access that, right? Within the surrender period and the percent I'm allowed to. And I do that as a one-time withdrawal. So that's an option, kind of like a savings account. Like I said, I could do a 1035 exchange, which is taking the cash value. And let's say there's a super new, fantastic product that wasn't around when you took out your IUL. We can take that cash value, roll it into that new IUL with zero tax implications and keep that policy intact, but under maybe a new, better product. So we can always access it through a 1035 exchange. We could surrender it. Let's say I'm 34, I paid into it for 20 years, 54, can't make the premiums anymore, don't need it for retirement. Maybe I inherited a lot of money. Who knows my reasoning, right? Let's hope we don't really want to surrender our IUL, but you could take that cash value and walk away, right? Cancel the policy, get all your cash out. And a lot of times, you guys, and if you look at these illustrations, that cash value ends up being more than the premium you put in. So at a minimum, it's a fantastic, can't call it investment because it's not, it's a contract, right? But getting more than you put in is always a good thing. Now, keep in mind, if you were to walk away from the policy on a surrender and you truly had $50,000, but you only ever put in $30,000, that's a $20,000 gain, right? That's going to be taxable. Not what we want to do, not what we're trying to accomplish, an option, right? The last way to access our cash value, and this is the power of the IUL for retirement, is through a very specific loophole of tax-free policy loans. And as long as you're doing it in the form of a policy loan, not a withdrawal, the company allows you to take that money, you're borrowing against your own account, basically. That money gets to stay indexing. You don't have to report it as income because it's a loan. And just like you would assume, a loan is going to have an interest rate. So the company is protecting themselves, right, by charging you a very small interest rate, but much smaller than if you were to walk into a bank and try to borrow to buy a car, right? They're really low, 3 to 4%, where I could go buy a car at 6%, 7% right now, even higher. Rates are crazy right now, but super cool option, right? So as long as we access that money through policy loans, it keeps it off of the income reporting. So it's not reported as income. Therefore, it's not taxed, right? And as long as you're doing it within the regulations of the product and not taking out too much, right? We can't decide, oh, I'm going to take out an extra 50 grand this year. Your policy is going to implode, right? So there's calculations that show us how much we can take out safely and make it sustain and last for retirement. And that last way is what we use to supplement retirement. So who makes a good IUL client? Who do you guys know that could benefit from one of these products? Okay. So the first one I'd say is people who want to start saving for retirement, but they don't have a lump sum to do an annuity. They have monthly premiums. IUL is a great option, right? If they're healthy enough, they can get a really good rating and put more money toward the cash value. Worst case, they have monthly premiums to pay and they can't qualify for the IUL. We can pivot and give them an annuity that they pay into monthly, right? But monthly premiums versus lump sum, I always look at the IUL first because it's 2 for 1. I get the death benefit as well as the cash power, right? What about clients looking for more whole life coverage than a final expense policy allows? How many 65, 70-year-olds do you run into who 40,000 just doesn't cut their goals, right? They want to leave more than that for their beneficiaries. And maybe they are super healthy. They can still get an IUL, right? They can still get a pretty competitive cost of insurance and have a whole life option. In that case, you're solving for that need I talked about with death benefit. but it's still a great option for them, and they'll take advantage of the cash value. Long-term care alternatives, I mentioned that one. So people who want to access living benefits, I'm not going to get into that today. I will show you guys in a couple of weeks what that looks like. But a lot of our IULs have living benefits where you can access the cash value or the death benefit, excuse me, which is usually higher while still alive. So it's a great long-term care alternative for people who missed the boat, didn't purchase long-term care young enough. So it's too expensive now, right? Lots of options there. Healthy clients, right? You have a healthy client who's needing to save for retirement, has nothing on the books yet, or maybe just needs to diversify. Look at an IUL every time, right? Your friends, family members, everybody. I believe everybody should have one. Grady, you said you have 6, right? I have them on my kids, myself, like they are powerful. Younger clients are always a shoo-in, right? If you have your, 25 to 40-year-olds who are working hard, you guys, I'm going to get to that one next, self-employed individuals. You're all self-employed. Like you don't have access to a 401k, right? An IUL is a great option for you guys to be able to put in more money than the IRA limits, right? We can only put in $6,500 a year, but an IUL, we could put in way more, right? So now you're creating a benefit for yourself. And how many self-employed individuals are we running into these days, right? Everybody's working for themselves. Everybody's DoorDash and Instacarts, and they're all trying to become their own boss. Essentially, we run into so many self-employed individuals who don't have access to retirement accounts but need to save for retirement. This is a fantastic product for that. Small business owners, right? IULs provide a super cool key person policy. I have a training on that I can send you guys that walks through how small businesses can leverage them for employee benefits. And then the employee actually gets to take ownership of that when they've done their vested time with the company. Fantastic product for that. People who are self-insuring, right? Maybe they can't be convinced of just life insurance. I have enough money. I don't need that term coverage or that final expense policy. But the combo might appeal, right? They see the benefit of the cash value and the savings and the power of locked in gains and never losing money. So self-insuring people. And then low risk tolerance individuals, right? People who know they need to be saving, they know they need to be putting money away, but they just can't stomach the market, right? I don't care. And this is something you can't judge people on. I say, I could be 30 and I know I need to be in the stock market, but it mentally makes me sick to my stomach. I'm not going to do it. Right? I'm just not going to do it. I understand why I should. I understand that I should diversify, but I'm not. You can't change those people's mind. You can't force them into this holistic idea of, you really should put some money in the stock market. That's okay. We're going to meet them where they are. And the IUL is a great option for a low risk tolerance individual who knows they need to be putting away money into something. Okay. And that is my IUL 101.